Hi everyone, and welcome to this new video where we will be discussing how to generate passive income as an example, $100 per month using dividends. Basically, dividends are really a perfect way to generate passive income because you're not required to do any effort. Basically, when you're buying a company that pays dividend, you're buying their shares in the Toronto Stock Exchange, or you're buying a dividend ETF. There is no requirement from you. You will be getting the dividend as a shareholder. As long as you hold those shares, you will be getting you will be paid those dividends on a monthly or a quarterly basis, depending on how the company pays their dividend. And today we'll go step by step on how to build a dividend portfolio. So as you can see here is in this example, the amount required to be invested will really depends on the average return. We have, for example, for 6%, you just need a capital invested of 20,000. So with $20,000 invested in the stock market, you can generate, without taking too much risk, a 6% average yield, which will be completely passive and you will be paid and deposited to your portfolio. So to build that portfolio, you can invest in stocks, and there are plenty of stocks that pay dividends. There are ones that are well known, well established, like the ones you see in the list here. A lot of Canadians who are invested in dividend portfolio, they buy either one of those companies, and I showed them here by sector. So, for example, there is the telecom sector. It's a known sector for having good dividend payers like TELUS, like Bell Canada. These companies pay around 6 to 7% yield, so it's really interesting. And also, we have the banking sector like Royal Bank, Bank of Nova Scotia, TD Bank. Banks are known for both paying dividends and also growing over time. If you look at the ROI, like L'Oreal Bank, 5 years ago, their share price, you will notice that it has increased quite substantially from 5 years ago. This is so you're getting the dividend on from the company on a quarterly basis in the case of Royal Bank, plus you're benefiting from the growth. So it's really perfect, and this is for sure for a long term, as a long term investment. And when you're seeking dividend portfolio, you're not playing the market. You're buying stocks that you like. You're buying stocks that you believe are excellent dividend payers with excellent historical dividend paying history to back it up, and that's it. You own that portfolio. You're not going to sell your shares anytime soon because you're buying them so you can generate that passive income and benefit from the growth in long term. Another sector that's interesting is utilities. There are Fortis and Emera. Both have really strong historical uh, history of paying dividends, and the approximate yield is 4 to 5%. You have the energy sector with Enbridge, TC Energy. As you will notice, most of the companies that we're having here have a strong business model, and it's very hard to compete against them. So, for example, if you take TELUS or BCE, not tomorrow that a company will come in and try to compete with those, because just to get into the telecom industry, the amount of investment required is just astronomical before you could make any profit. Those are existing players with their infrastructure, so they have like a stable business model they can generate income with. Same thing with Enbridge, same thing with TC Energy. You're not going to start a pipeline tomorrow. So these companies have long-term business model that generate cash flows. This is why they are paying dividends for such a long time, and it's a way for them to have shareholders, and especially quality shareholders that are the ones that are buying the shares and not trying to speculate. They're just buying the shares for the long term, for the dividend and the growth in the long term. There is also the option to have dividend ETF. So a dividend ETF is basically, it's like you're invested in a portfolio of dividend stocks. So you are diversified already. So you don't have to pick stocks from various sectors because the dividend ETF has already a portfolio of dividend stocks among various sectors. And there is a list here from the ones that are super popular, like XDIV, VDY, ZDV. There is a little variance between each one depending on their objective, but overall, they're excellent dividend ETF stocks. And we have also the REITs. REITs are known to pay dividends, and they have a track also for paying dividends, and they have strong business models. You have Smart Center, Canadian Tire REITs, for example, and they are excellent if you want to diversify your portfolio. So this is an example of a dividend portfolio. So it could have, for example, you could have Bell Canada BCE, Fortis, and a dividend ETF, and of overall 20,000 invested. And you could see that the yield for each stock, for each dividend ETF, on average provides 5.6%. So with 20,000 invested, you almost there have almost $180 per month passive income. So this is just an example. You could play, you could change, you could pick the stocks that you believe in. Personally, I would have something that's known for growth and dividend, even if the yield is not that high. For example, for certain banks, even if the yield for RBC is not super high. However, I know I'm getting also the growth, and mix that with a high dividend ETF or a stock like Bell Canada or like TELUS that are known for high yield and also long-term growth, maybe slower than a bank, but still. And this way you have kind of both of a growth dividend portfolio and not just dividend. It will have growth and dividend. The dividend ETFs are also perfect for growth. They capture the growth, so they have a reasonable yield also, and they allow you to reach that $100 of passive income. Now you have to choose the right investment account when you want to invest in dividend portfolios. For example, if your a TFSA is ideal, obviously, because everything earned within a TFSA is tax-free. So you can reinvest your dividend without worrying about taxes. You can withdraw money if you would like without worrying about any tax implication. Whereas for an RRSP, the dividend grows tax-free, but until withdrawal. So when you withdraw the money, you will be taxed. Even if you contribute only 20K, but then your account 10 years from there was because of the growth, because of the dividends, it's higher, but any amount you withdraw at that point will be taxed. It's not just your initial contribution that will not be taxed. So it's perfect for more for retirement objective, whereas TFSA is perfect for any other scenario because it's much more flexible. Now, the growth strategies within your dividend portfolio, the number one is to reinvest your dividends. If you can reinvest your dividends, that's perfect because reinvestment allows you to acquire more shares and again, compounding all that income makes the dividends even higher with over time, and also your growth higher because you're acquiring more and more shares. And you can add, obviously, if you could add capital regularly to your investment account, that's absolutely perfect, and it's the way to go. Don't try to time the market, invest regularly. This is the way to beat the market. And avoid chasing extreme yields. In this video, I'm focusing only on really dividend ETF that allow you to capture the growth. There are a lot of ETFs that offer higher yields, like 10, 11%, but they put a cap on your growth. The growth is limited. That's why uh, they are not suited like for someone who's looking for growth and dividend. Better stick with something that pays a regular dividend yield. Like for dividend ETFs, it should be 5, 6%. For a stock, depending on the sector, it's never like if a bank pays if banks are paying in general 5 or 4%, and you see a bank paying 20% or 10% dividend yield, you have to run away because there is a problem with that bank or with that stock. There is something going on there. If the price is depressed, there is a reason why it's paying an abnormal dividend yield than the average for the sector. So when you are looking at the dividend yield, always compare with the sector when it's a stock for a company. So banking 4 to 5%, REITs maybe 7, 8%. That's a regular yield, but 20% that's not regular yield. There is a problem there. So just keep that in mind. Don't just chase higher yields. For a dividend ETF that pays 10%, just understand why it's paying such a high yield. It's because it's using covered call, and understand what's the impact of covered call. So a covered call will limit your potential for growth. So But so if you're looking for growth, no cap on your growth, plus a reasonable dividend yield, stay with the classic dividend ETFs like VDY, like XDIV. They are diversified. They are kind of a representation of the Canadian economy. They have all the sectors there. And follow the dividend growth history. You could check various websites where you could look at how many years they have increased and paid their dividend each year. There is a list of dividend aristocrats. I can put a link. I will put the link to Canadian dividend aristocrats and US dividend aristocrats. You can pick from those. So you don't have to do like a lot of research. The research is already done for you. When a company is designated as an aristocrats, that means that it paid dividend for Canadian aristocrats. It paid dividend for more than 5 years, and there is plenty of stocks in Canada that have a track record of more than 10 years, including some of the banks, including utilities, um, including some consumer basics like Metro and company, Loblaws. So all these you could pick from those, so you don't have to reinvent the wheel or anything. There's already research that's done for you already. Tax rules to know. So it's just a recap. Canadian dividends in a TFSA, 0% tax. In an RSP, taxed only at withdrawal but tax. So basically tax is deferred. You're not taxed right away, but you will be taxed when you withdraw. And all these examples that I showed here are Canadian dividend. It matters because when you are getting a Canadian dividend in a registered account, you're not subject to any withholding tax. Whereas if you're getting a US, for example, a dividend from a US or international, then you're subject to withholding tax of 15%. And this is true for TFSA. For an RRSP, there is ways to avoid that, but you have to follow the rule in place. Generally speaking, if you have a US stock that pays dividend in an RSP, you're exempted from that withholding tax of 15%. Same with an ETF, as long as it's invested in US stocks directly that pays dividend, then in an RSP, you will be exempted. To take full advantage, it's better to stay with Canadian dividends in a TFSA. So the key steps quickly. So you have to open a TFSA on RSP if it's not already done. Choose 3 or 4 Canadian dividend paying stocks, ETFs with stable dividend. Invest the amount that you would like and reinvest that dividend to accelerate growth and monitor annual dividend increases for the companies that you invested in. So I hope that this video was clear enough and helped you. Thank you very much. And if you like the content, please subscribe. If you have any questions, please go ahead and just ask your questions in the comments.